So, good evening, everybody. It's great to be here. It's been a while, but it's great to be here back in person. So, I'm going to figure out how to work here. We're going to just give an overview of the investment strategy that we employ for managing your money in the Tradex Global Equity Fund as the sub-advisor. We execute this investment strategy using a vehicle called closed-end funds. These are a type of mutual fund that have a value and then trade in the stock market, and they can trade at a discount or premium to their net asset value. And what we try to do is buy these funds try to buy attractive funds that are trading at discounts to their net asset value, and to capture the volatility that occurs in these discounts as funds and their underlying investment strategies go in and out of favor. So in that way, we're kind of a value-oriented manager in terms of the way we think about things. We want to buy cheap stuff. But in terms of the underlying exposure that this fund has, it's very diversified to global equities. We invest in funds with lots of different types of investment approach, and some of them are growth-oriented strategies, some are value-oriented strategies, and some do a bit of a mixture, and they're kind of what they call core strategies. So the overall exposure is pretty diversified. So over the next slide, just in terms of what process we go through, we do a lot of work meeting with the managers of the various closed-end funds. We talk to them about the investment processes that they employ. Each of these funds have a board of directors, and they are responsible for the governance of the closed-end funds. And so we meet with them as well, because some of the issues, if a discount, for example, stays very wide for an extended period of time, there are certain actions they can take to narrate those discounts. We obviously do a lot of work on the performance of the strategies, but we're really trying to understand who the people are, what the investment process is, and what the likely return profile of that type of fund is. And then by evaluating the discount, we also understand what the value proposition is. We then use all of these funds within our universe, and there's about 450 of these funds listed globally, and we look at where are the best values available to construct a portfolio, and we look at the see-through exposure that we get from that, and in terms of what is the country exposure, what is the sector exposure, what are the various style biases of each of the funds, and then we size positions appropriately based on it can be the value proposition, but also their relative size as well. We also want to touch on ESG. It's become a very hot topic. Pretty much every manager, if you go back 5 years ago, no manager had a page in their presentation on ESG. Now everybody has a page in their presentations. What we do, we've been long advocates of governance within our closed-end funds, including meeting with boards. We always vote our shares, and it's an important part of the engagement we have with the funds. We also work with a company called Sustainalytics, who reviews all of the portfolios and kind of lets us know how they rank based on their portfolio in terms of what exposures they have. Because we are investing in third-party funds, we cannot directly influence what is in those funds. That's the manager of those funds' decision. But what we can do is make sure that this is something that they're thinking about and how they're thinking about. One thing I can tell you is there are many different approaches to ESG. So it's not, there are these Sustainalytics ratings, but that's not what everybody necessarily buys into as how you should assess a company from an ESG point of view. Because you can look at the point in time, how is it right now, but you can also look at what is the direction of travel. is this company improving its ESG? In which case, that might be a company they want to support. So you know, the idea behind our approach to ESG is just making sure it's something that we talk about. But what that also does mean is that if a manager adopts more of an ESG approach, it will mean that they will have, more than likely, less exposure to sectors such as energy and materials, and more exposure to things like investment, information technology, consumer discretionary, because those companies are often very light in terms of their ESG impact. And so you do get a sector bias in those ESG funds. This is a chart we've used a number of times. It is the components of a hypothetical return. It's really just trying to, is this microphone still working? Good. Okay. So when we invest in a closed-end fund, it can have...
Sorry.
Is that working? Yeah. Technology, everybody. So with closed-end funds, each closed-end fund, say it's a Japan closed-end fund. Japan will perform, the overall market will perform either in excess of or below the average index, which is the benchmark for this fund is the MSCI World Index. So let's assume it outperforms, that will add 2%, say it outperforms by 2%, that's the country component of return. Each of those managers of the closed-end funds, they follow an active investment strategy, and the hope, given that they pay a fee for this, is that they will generate outperformance over and above what you can get from an ETF or the market. So whatever they do there, that's the holding NAV performance part of the return. And then the final part is the excess price return, which is the change in the discount that occurs during our holding period. So if, say, we buy something, I've got a 3% here, say we buy something at a 15% discount, it narrows into a 12% discount, that's that 3% capture that we look at. So now I'm just going to touch on market performance, and it's been obviously an interesting year with lots of volatility that you can see, and you know, Canada was the top performing market within our universe, and we'll go into touch on why that is. Australia as well, US continued to do well, and the UK also did quite well. On the downside, Japan was an underperformer, and emerging markets were also underperformers. We do, by virtue of closed-end funds, get some small cap exposure. Small caps generally was not a great year last year. And then in terms of the sector exposure, this is kind of why those markets outperformed. What do they have a lot of exposure to? Energy, and energy rose by around 50% over the last the 12 months in this period. And so any stock market that has a high proportion of energy sector in it obviously did well. And there are obviously other reasons there, but sector composition is an important driver of country returns. And then the sectors which, you know, healthcare did well here, but actually a lot of this is a large company index. So for example, investment technology is dominated by mega cap technology fund companies, Apple, Microsoft. You know, they all did very well last year, but under the surface, quite a lot of technology companies really didn't do well. Similarly, quite a lot of healthcare companies didn't do very well as well. And then, you know, communication services, you've got there down the bottom as the weakest sector. You know, we've had a couple of companies which are now included in there. Netflix, which has suffered a considerable drawdown, and then also Facebook, Meta. That's trying to leave that one up. You know, that was what drove those returns. So with that, I'm going to hand over to my colleague Mike Sugru, who's going to talk to you about performance and fun.
Good evening, everyone. Okay, so first chart here is the last 5 year performance of the fund. Basically, you can see it's come off the lows post the pandemic onset, but towards the end of the chart, you can see that more recently performance has been a little bit more challenging. So on this slide, I'm going to focus on the 1 year numbers. Despite an absolute return for the year, we actually lagged the benchmark of the portfolio, return of 9.5%. So we would have loved to have been standing here last year when that number was actually a positive 16%, but that maybe in part does explain some of the numbers that we're going to go through in the presentation. So at the bottom of the page we've got the attribution of the performance, and this explains how the 7.5% that we lagged the benchmark was generated. So we had 2.5% that came from country allocation, which is effectively us being in the wrong countries. We had 3.8% of that 7.5 come from NAV performance, which is the performance of the managers we selected against their chosen benchmarks and their underperformance. And then we've got 1.3% of that 7.5 comes from effectively that discount widening aspect that Mike just spoke about. So over the year, we effectively saw the portfolio, closed-end fund within the portfolios slightly widen in discount. One point to make on the NAV performance number is that the way that our attribution system measures performance, the small cap effect that Mike just mentioned is bucketed in that NAV performance number. And whilst closed-end funds do tend to have a small bias towards small caps, we have some dedicated small cap managers that we invest in directly. So again, with that being a challenging year, in particular for small caps, part of that number, it does explain the 3.8%. And then also for sector funds that we invest into, they're measured against the broader benchmark as well. So the sector effect does get picked up in that number as well. Before we get into a little bit more detail about the performance drivers and trading and explaining those numbers we just spoke about, we've got a slide here that shows the size-weighted average discount of the portfolio. So this chart effectively takes every discount of each of the closed-end funds held within the portfolio and weights it depending upon the amount of each closed-end fund and the amount of the closed-end fund it represents of the overall account. So what this chart is telling you over the course of the last year, discounts effectively accounted for 2.5% or 2.5% wider on average for the portfolio. And so whilst that number on the previous page wasn't quite as large as that, that does explain some of the widening, but also as part of what we're trying to do when we're managing the portfolio is constantly tilt the portfolio towards those funds that are trading at the cheaper end of the discount range and buying those funds that effectively offer us the best bang for a buck on the positive side when that discount re-reverts and narrows. So onto the performance drivers. We'll start with country, so that negative 245 basis points. It wasn't all bad, fortunately. Overweight to the UK. The UK market was up 12.5% in Canadian dollar terms, and we had a 2 times weight to the UK. So that contributed 43 basis points positive performance. We're also underweight to Hong Kong, which fell by 12.7%. So again, that contributed a positive 15 basis points. On the negative side though, the out of index Chinese exposure that we invested into, and the Chinese market was down 33% over the course of the 12 months. We didn't hold a lot of Chinese exposure at the beginning of the year, but given its underperformance through the year, it was something that we added to, but unfortunately we were early and China has continued to disappoint. We also have an underweight to the US, and that market was up 13 and a bit percent, and we've got roughly a 0.8 times weight to the US, so that detracted 59 basis points from performance. From an NAV perspective, The largest contributor for the year was Miller Howard High Income Equity. This invests in a number of high-yielding equities, and those high-yielding companies did much better than the broader market over the year, and the outperformance of 63 basis points was contributed. We also had some positions in MLPs, Clearbridge Energy Midstream. So this is one of those sector-focused funds, being energy-focused, did much better over the course of the year, particularly towards the end of the year, the first quarter this year, with energy prices rising, and that contributed 53 basis points worth of performance. Allianz Technology Trust is one of a few technology sector funds that we can invest in. It's invested much more in the mega caps and those names that did very well over the year, and it outperformed by 43 basis points. On the negative side, BlackRock Innovation and Growth and ND Next Generation Connectivity were effectively two new funds that were launched in the US last year. They were on IPOs in towards the end of the first quarter and into the second quarter. And when closed-end funds are issued, they're issued at net asset value. So when we talk about that discount or premium, it's always to that net asset value. Towards the end of the year, they came under some pressure of US tax loss selling because the NAVs hadn't done particularly well. And what that effectively means is that you have more sellers than buyers, and that widens the discount. And the discounts widened out to double-digit discounts, and we felt that that was an attractive entry point for both of the funds. However, as we saw that sort of rotation from growth companies or growth into value in the market and growth underperforming, particularly with BlackRock Innovation and Growth that invests in a lot of mid and small cap growth companies, the NAV performance deteriorated further. So with US tax loss selling, what you tend to see is the discounts widen ahead of the end of the year, and then post the new year, that discount contracts. To a certain extent, we've got the discount right in this one, but unfortunately the NAV performance did detract a reasonable amount of performance. And then the last one to mention on NAV performance is Polarcap Technology, again another technology sector fund. This fund tends to invest a little bit more into mid caps that just didn't do as well and detracted from performance over the year. From the discount perspective, the 127 basis points negative, the biggest contributor to discounts was Scottish Investment Trust. Now this is a deep value biased manager who hasn't done particularly well over the years for obvious reasons. On a global basis, whilst we saw the chart earlier on Canada, on a global basis, growth's actually been outperforming value for some time. This manager had disappointed, and there were some agitated shareholders, and the board took it upon themselves to decide to move that mandate to a growth mandate, and they merged the fund with JP Morgan Global Growth, and JP Morgan Global Growth has done a very good job over the years. It was trading at a premium, while Scottish Investment Trust was out on sort of a 10 or 11% discount. So at the point those two funds merge, they merge on an NAV for NAV basis, and you end up holding the better performing fund, and the discount narrowed right the way in, and that contributed 30 basis points of performance. We also did hold Berkshire Hathaway. We bought that towards a 40% discount, and that then narrowed into sub 30, so that discount thesis worked out, and we were selling it. And then also Sprott Focus Trust contributed to performance of 23 basis points. That's something we were buying towards sort of the high teen discounts, and that narrowed to a single digit discount where we were able to sell. On the negative side, Prosus is a company, it's actually a holding company, and most of the investment or the underlying exposure in Prosus is a company called Tencent, which is a Chinese technology company. Again, we felt this was cheap. It was a way to increase our Chinese exposure, particularly in that sort of technology space. But with the sort of increasing regulation and monitoring of the Chinese government, that aspect of the market really hasn't done well. And we've seen that discount widen from probably around 40% where we bought it for the account to over 50%. Polarcap Technology, we mentioned under the NAV performance. It's very common that when a fund goes through a period of NAV underperformance, that leads to discount widening. And that's what happened with this fund. So we'd held that around an 8 or 9% discount, and it widened out to about 12 at the end of the period. So what were we doing during the year whilst this was all going on? Just to explain the chart you're looking at, the bar chart on the left-hand side. The blue chart, or the blue part of the chart, is the index weight at the beginning of the year. So the percentage we held in Europe ex-UK at the beginning of the year was around 18%, and the yellow bar is what the position was, or the exposure was at the end of the year. So it reduced to about 16%. The dotted lines that you see over the blue and the yellow are the beginning and ending index weights. So for example, again, Europe ex-UK, we effectively decreased the exposure by 2%, but the benchmark exposure for Europe ex-UK fell by 1.3%. So our relative action, or the active management of that component, was to decrease the exposure by 0.8%. Now within that 0.8%, the names on the right-hand side, we show the buys and the sales. We were actively trading the exposure, and we bought into a company called European Opportunities Trust. This is a fund that has a very good manager over the long term. He recently spun out and started his own business. He took his long-standing investment trust with him, but historically trading at a premium, he's run into some performance difficulties, and the discount widened out to 11 or 12%. So we felt that was a good opportunity, having done some due diligence with the manager, to buy into a fund that disproportionately widened. Group Brussels Lambert is something we bought into on restructuring, and on the other side of that, we were selling First Trust Dynamic Europe on discount narrowing, and European smaller companies on NAV outperformance, and European assets, which also narrowed in from a 10% discount in towards 2%. So that just gives you a flavour of what this slide shows. I'm not going to go through every single line, but you can see for Japan, the active trading wasn't as much. The exposure only went down by 0.2%, and there were a couple of purchases and one sale against that. Just some names to potentially highlight. Obviously under the US, where there was a significant increase in exposure to the US, those BlackRock Innovation and Growth and MB Next Generation Connectivity that I spoke about on the previous page were a big part of that increase in exposure. But we did sell Berkshire Hathaway and the Spot Focus Trust on the discount narrowing. So that's kind of that process in action. The last name I'll mention here, at the bottom of the page, we did add some gold exposure at the back end of last year and the beginning of this year, see with the inflation story taking hold. The last couple of slides before I hand back to Mike just give you some portfolio characteristics or positioning again. So to summarise, from a country perspective, we're underweight the US, overweight the Eurozone and Japan, and overweight the UK. Sorry. And then from a sector perspective on the next slide, we're overweight tech and healthcare, and that's effectively funding the underweight financials and consumer staples.
So I'm just going to say a few words about our kind of outlook from a market perspective. The first one here is what I would call a low conviction opinion, which is, no one really knows how this conflict's going to resolve itself. It seems that I think the objectives seem to have changed a little bit from a Russian point of view, and potentially they'll see a situation where they can claim victory and or at least some kind of victory, and there's some kind of ceasefire, albeit those tensions are not going away, and that could fire up again. We obviously the COVID situation, I think we're continuing, particularly in the developed world. Really, it's become endemic. A lot of people have got the vaccines, or they've got natural immunity from having had the virus. So we think the normalization of economic activity and society continues to evolve. The emerging world, it's obviously we've got what's going on in China, and that's probably going to take a little bit more time. I think the the Western vaccines are much more effective, and it's kind of distributing it to the emerging world as well. You know, obviously we talk about, or was mentioned about inflation, and inflation is obviously very high, and if you went back, you know, 12 months, you know, there were a few people talking about it, but nobody kind of really expected it to be as high as it has been. We think it probably, at least in the nearer term, will start to stabilise and potentially even drop, and part of that's just from the fact that it's a 12-month thing, and the high increase months start dropping out of the headline rate. But also because, you know, some of this inflation, at least the initial inflation, has occurred because of the supply chain issues we all hear about. And as economies normalise, those situations should ease. And a lot of the inflation so far has been in produced goods, whereas you know, we haven't seen as much inflation in kind of the service sector. So now that may come, but it's probably not going to come, you know, in the next 12 months. So we think that, you know, yes, there's going to be interest rate rises. It'll be interesting to see how they affect the economy. You know, we have much more debt in the economy. More debt means more interest service payments. That means the kind of choke point for economic activity may be a bit lower than what we think. So maybe, you know, you raise rates, you know, several times. You know, mortgage rates are back up in the US, so that could also help reduce growth without completely choking it off. Definitely we think Europe is going to suffer for an extended period of time with these high energy costs. There's no quick solution to that, and their dependence on energy from Russia. You know, the elections in the US, I don't think it's any surprise that, you know, I think the Democrats are going to do very badly. We're going to effectively have you could argue we already do, but a government that isn't going to pass any meaningful legislation. It's going to start focusing on the presidential election. But that also has some knock-on effects for sectors like healthcare, where, you know, one of the concerns is that there's increased regulation. That's probably not going to happen. We think, you know, energy and commodity prices have risen quite a lot. We don't think they're going to revert lower anytime soon, but probably not going to make new highs, at least in the next 12 months. But, you know, that can change with developments. So overall, you know, we're obviously, it's a very turbulent time in the markets right now, and that's not that surprising, right? You've got a situation where a lot of market participants haven't been in an environment where interest rates are rising. There is inflation in the economy, and so I think there's a lot of confusion in the markets about how people should be pricing assets, and we're going to kind of have to work through that situation. I think that's probably going to take a little bit of time, probably you know, at least another 3 months. I think one of the things that we are seeing is that companies are still being able to pass on some of those increased costs, and the earnings are actually doing reasonably well. That should support equities, and also the fact that because we've fallen or gone sideways, those valuations have actually improved because we have still had that earnings growth. So we're relatively, well, we're reasonably optimistic that we'll have a positive return. I don't think it'll be a big positive return, but I do think it'll probably outperform bonds. And we do think that non-US equities could do better, and that's partly a sector issue in that the US index is very much dominated by the large technology companies. Those could run into some difficulties and have been, especially in the smaller cap sector. So We're reasonably positive on healthcare. We've been adding exposure there, and we're also positive on kind of infrastructure related assets as well as they become more valuable, and that's part of the pipelines that we have. So summarising, it's a value-oriented strategy. We use closed-end funds. It's a very diversified exposure. We try to take advantage of that discount volatility and position the account to do well over extended periods. So in terms of our positioning, we're overweight to Japan, UK, Eurozone, and we have a small out of benchmark exposure to emerging markets. We're neutral to Canada, we're underweight, which we have been for some time, to the US and Australia. And then the sector base, there's kind of some value sectors here with your kind of energy materials offset by some overweights to information technology and healthcare, so fairly diversified. So with that, happy to take any questions. Yes.
Your allocation, sector allocation puts energy fairly low, considering that it has been the performing sector over the last 12 months.
Mm-hmm.
And given the current geopolitical challenges, and particularly with the unknown factors in energy distribution, what is your rationale for keeping your allocation on energy that low?
So, we're often driven by the value that we see in our closed-end fund universe. We are above the benchmark exposure to energy. One of the areas where we can access energy at a discount using closed-end funds is in midstream energy, and we have had a position in that area, and that's done very well over the last 12 months, and you could argue that we should have had more of it. But I would equally say that there are times when that exposure can be quite volatile, and so in March 2020 was a great example, and so we don't want to have too much of it. We want it to be diversified because I think if you stood here 12 months ago and said which sector is going to outperform by 50%, I don't think there'd be many people who would have said it's going to be energy. So it's easy to say once it's happened.
I'm looking forward.
Yeah.
With the energy crunch.
Well, I think
Particularly.
sure, but energy has performed very well. So and I'm not saying that structurally that energy might not perform well over the next decade, right? Because one of the things that we're hearing regarding energy companies is that whereas in the past they've been quite undisciplined about their capital allocation decisions, they now actually are being quite disciplined, and so that likely will limit the amount of extra supply that comes on stream in response to this. So, I take your point, and it's certainly an area that we're looking at, but we probably, to add to exposure, we'd probably like to see a little bit of a pullback because it's done so well. Yes.
The increased savings rate that we hear about in Canada, and I assume the United States as well, I suspect is contributing to inflation and housing costs as well. Is that high savings rate coming down over time? Can you tell me? And if so, is there an end to it so that would perhaps contribute to less inflation?
Yeah, I think it has been coming down, and I think one of the reasons it went up so much is because in the pandemic, obviously people couldn't spend as much money as maybe they would have done on services, and so what happened is they bought a lot of goods. And so, and this is where the supply chain issues come through. The companies that produce those goods didn't anticipate that much demand, and so they didn't have the products available, and so therefore prices go up to create that kind of equilibrium. So as we come out of that pandemic and people are looking to spend more on, you know, service activities, going out to restaurants, that type of thing, then that pressure on those goods ought to recede. But equally, then you start getting pressure on kind of the services sector. So it's coming down, and you could also argue that the baby boomer generation are transitioning from being savers to becoming net dissavers, and so that also is going to reduce that excess savings. Any other questions? Okay, thank you very much, and thank you for your support.